Good afternoon, dear colleagues. Thank you very much for attending our today's event dedicated to the presentations from about Islamic finance, the guidelines, Islamic financial products, and the second, Sukuk, Islamic Securities. So here I'm inviting Yilnur Dasmagambetov, head of AIFC administration, for intro. Thank you very much. First of all, I wanted to greet all of us in AIFC. Today we'll be demonstrating to you two guidelines that were designed on account for a grant from Asian Development Bank. Special separate thanks are being extended to Asian Development Bank, and we will have a consultant.
And then very happy that you're helping us to build guidelines and handbooks to further develop Islamic finance, not just in AIFC, but also in Kazakhstan and Central Asian region. В целом, как вы знаете,
In general, as you know, in the past 4 to 5 years, AIFC, after commissioning, paid tremendous attention to Islamic funding, not only Islamic banks and banking products, also exchange instruments. This year, during Astana Finance Days, we commissioned compliance ETN. Now we are striving to release in circulation Sukuks. And you know that is not easy, particularly that will be our debut. But in accordance to plan that we have developed together with the Islamic Development Bank, we are developing that plan, and despite all challenges, we trust in Islamic finance, not only in Kazakhstan, but Central Asia as well. We would like to thank all of you for your support. I know this way will be not easy, but altogether, with the help from ADB, with the help from our consultants and our partners from Islamic Bank, we will succeed. Now I'm giving the floor to Medina. Thank you very much, and a warm word of welcome to be said in the online regime, senior country specialist from ADB, Mirzo Iskandar Gulamov.
Good afternoon, ladies and gentlemen, guests, participants of this event. On behalf of Asian Development Bank, I would like to thank AIFC for arranging this event and also giving us opportunity to provide some remarks. My name is Iskandar Gulamov, and I'm representing the country office of Asian Development Bank in Kazakhstan, specifically in Astana. I oversee our sovereign operations and also support our delivery of knowledge, advice, and capacity, including on areas such as Islamic finance. As we all know, Islamic finance or Sharia compliant financing is one of the fastest growing segments of the global financial system, which has been growing at double-digit annual growth rates over the past decade. As of 2019, the industry's global assets have reached at least 3 trillion, and this is set to reach 4 trillion by 2024. For comparison, the cumulative GDP of CIS is 2.5 trillion, which signifies the potential and significance of Islamic finance. And the industry's continuous expansion resulted in Islamic finance reaching systemic significance in a number of countries of Asia, such as Brunei, Bangladesh, and Malaysia. These are the countries where Islamic finance has achieved at least 15% of market share in domestic banking sector, which is quite significant. But even countries that do not have a predominantly Muslim population are also beginning to open their doors to Islamic finance. Countries like Luxembourg, Hong Kong, United Kingdom, and South Africa have recently debuted sovereign sukuks. And as we can all see, all issuances were at least twice oversubscribed, which demonstrated the strong demand for Sharia-compliant financing globally. Significantly, for Asian Development Bank, we have 14 member countries that have a majority Muslim population. and we have 5 of the top 10 countries with the biggest Muslim population globally. We estimate that Asia requires infrastructure investments of at least 700 billion per year to sustain its growth trajectory, especially after COVID. And given the demographic composition of our member countries and realizing these vast investment needs, we at ADB recognize the potential role of Islamic finance in promoting inclusive growth and achieving sustainable development in the region, including through funding infrastructure and green and ethical investments. This is the reason why ADB has been engaging with AIFC for the past several years on promoting Islamic finance in Kazakhstan. Our initial engagement with AIFC, which is a strategic partner for ADB and has a strong mandate to promote Islamic finance, has started in 2014 with initial work under our Knowledge and Experience Exchange program, where we looked at the foundations and legal framework for Islamic finance, followed by the Regional Technical Assistance, which is Islamic Finance for Inclusive Growth project, the results of which we will be listening and reviewing today. Under the most recent regional TA, we have completed phase 1, including comprehensive capacity building in 2021, and this new phase starting 2022. I understand that close to 100 trainees were trained, and there were 21 participants institutions across Kazakhstan, including 63 SMEs, which is quite important. Now we are working on the second phase of this technical assistance with the key outputs, including developing the Sharia compliant central liquidity facilities, which would help local financial institutions to manage their liquidity in a Sharia compliant way, developing guidelines for Islamic products for most common Islamic financing and depositing products, preparing guidelines for Islamic bonds, Sukuks, which would be a basic guideline for market participants to understand structuring of Sukuk, including legal and Sharia requirements, as well as looking at the green, sustainable, and responsible Sukuks. And last but not least, the team is also working to develop a concept paper for sovereign Sukuk issuances based on the local context and experiences of other countries, which will be presented to the Ministry of Finance. I do understand the team met with the Ministry of Finance and received the feedback already. All of these deliverables are capacity building centered to empower the AIFC and Ministry of Finance of the Kazakhstan through the transfer of knowledge and strengthening the enabling environment of Islamic finance in Kazakhstan. I wish you a very useful and productive learning today, and also welcome the active discussions. Many thanks, and I will stop here.
Спасибо большое, Искандер.
Thank you very much, Iskander. And now I would like to invite Mr. Najib, representative of IFAAS, director of the company we've been actively cooperating with in the last 2 years. Together with them, we performed a number of activities dedicated to Islamic funding, financial literacy. We worked with various companies of financial and non-financial sector, universities, SMEs, some lecturing for spiritual administration of all Muslims of Kazakhstan was done. So now we are about to discuss the products will be of use both for companies to deal with Islamic financing, as well as the companies who want to release in circulation Islamic Securities, Sukuks, and in general. This is for the population to know the structure of the Islamic funding, what documents are required depending on the bargain, and depending on the principles of the Islamic financing. Najib, you are given the floor, please.
بسم الله الرحمن الرحيم والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Salamat, Sizbi. Kalınız kalay. Çakış? Alhamdulillah, alhamdulillah. Menin adım Najib Al-Aswad. Please do not expect more Kazakh. That's the end of my Kazakh language skills for the day. I'm very pleased to be with you here today, and the possibility that me and you have met online is very high, I believe, because if you have been participating in this first phase of the project, I was involved in the trainings. So it will be great, inshallah, to maybe follow up after this session. I'm not sure why you are staying away. Come here, please. Let's be closer. Let's have more engagement. I prefer this not to be a khutbah. I don't know how the interpreters will interpret khutbah, but I don't want this to be a long lecture. I want this to be an engaging exercise. So I would like, to know more a little bit about your introductions. If you can come, please. We can try to have a dialogue, inshallah, so we can keep this flowing. And I appreciate it's the afternoon session, so it may not be the ideal time for brainstorming and thinking. So we'll try our best to keep this, educative and also a little bit entertaining, as much as AIFC team allows. So the reason why we are here today is to discuss two things. The first session of the day will be discussing guidelines for Islamic banking and financial products. So these guidelines are designed to help not only banks, but also non-banking financial institutions that are interested in offering Islamic financial products. So this includes deposit products, investment products. It also includes financing products. So it's across the spectrum. Of course, today we will talk about a summary of them, and later on AIFC will publish all these guidelines in English and in Russian. So the structure of the first session about the guidelines will have three main components. The first one will be an introduction to Islamic finance, where we will talk about an overview for people who have no background. What are the principles of Islamic finance? Key similarities and differences between conventional and Islamic finance. Then we will move to the Islamic liability and investment products. So we will look at how can financial institutions and banks attract deposits, attract money from the public, from retail, from also corporate institutions, SMEs, and so on. Then the second session, or the last part, will be about Islamic asset and financing products. So that's how can financial institutions, will probably use the term Islamic Financial Services Provider, or it will be abbreviated as IFSP across the day. So how can such financial institutions deploy money, provide money, across different needs, as you can see, auto finance, personal finance, machinery finance, in accordance with the principles of Islamic finance. I'm hoping I'm not too quick for the interpreters. Please forgive me. That's good. I got an okay signal. So the first section will be delivered by my knowledgeable colleague, Omid John Yorkulov. He is a local, a regional, I would say. He's an Uzbek national, very excited about Islamic finance and studying his PhD and part of our team. And I believe he will be doing his section in Russian, if you are happy with this. And then I will continue with this afterwards in English. Omid John, please.
Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Sayyidil Mursaleen wa ala alihi wa sahbihi ajma'in. My name is Omid John, and it's my privilege to present our company in today's event. And because I'm originally from Uzbekistan, and in order to add some more diversity into our presentation, I would like to present further in Russian. Thank you. Сегодня в первой части мы хотим представить вам введение в исламские финансы.
So in the principle, I think that many of you have a notion of Islamic finance in your mind. So I hope for some of you it will be a repetition, but those who never had exposure, it will be like an act of enlightenment. So what is the difference between Islamic finance and conventional finance? We will discuss the main prohibitions, main principles of the Islamic finance. First is, of course, the prohibition to charge interest rate. Scientists in the sphere of Islamic finance deem money as a means of exchange. It's not a commodity. Money doesn't have any internal value. When money is used to produce more money, that is called riba, or interest rate, and regardless how that additional sum, maximum or minimum, it is prohibited. Islamic finance is the only system within the framework of which you see the difference between a commodity and money from the standpoint of their commercial essence. Any system except of Islamic funding allows selling money as a real asset, while in Islamic funding, money and real assets have different essences. They cannot be made equal. That is why money is not the purpose. This is just the potential richness. And money may be used only as a tool of exchange and the measurement of value. So we can talk about the wisdom behind those prohibitions for hours, for days, at the macroeconomic, at the microeconomic, and even psychological spheres. So interest rate, and there are certain suppositions and observations demonstrating that certain transactions impact the character of a human being, on that human being's attitude to other people, and particularly commercial bargains. The next thing is the prohibition of uncertainty, excessive uncertainty. So, in other words, in Islamic finance, there exists the prohibition to have excessive uncertainty and gambling. Contracts with high uncertainty are prohibited, and there's great wisdom behind it. There are certain
whatever leads to conflicts, to disputes, to trade disputes, is prohibited. But conflicts, what do you think? What is the essence? What is the essence of this, of the hara ban, or the ban on uncertainty? Please raise your hands. Please raise your hands and just give us your view, please. Yeah, in my understanding, is the purity of the relationships, of each of the parties. Each of the parties know what to expect at the end of a bargain. Right, absolutely. In Islamic finance views transactions as social contracts. And Islamic finance seeks first and foremost to protect the weaker part from exploitation, to make sure they're not dominated by anyone, and clear-cut terms and conditions. And I want just to emphasize the beauty of Islamic finance. Each part of them has to do with the so-called musavat concept. In other words, equity, doing things on an equal footing, something God Almighty has decreed to exist between the parties. Well, a classical illustration of hara or uncertainty is like, say there is a fisherman standing on the seashore and says to his colleague, "I'm selling you the fish in the sea." So we wind up in a situation in which it doesn't really own what he or she is going to sell. or other contracts say contracts replete, full of uncertainty. So hara leads to enmity, to oppression and oppression. So hara is number 2 ban, riba number 1, hara number 2. But Islamic finance, on the contrary, promotes mutual understanding and mutual respect. The next step. The creation of asset-backed financial transactions. So the following principle is key. We must create financial transactions which are based or backed, which are asset-backed. Islamic finance, I stress it once again, Islamic finance sees or views money as a lubricant for the real economy, something that promotes, something that drives the exchange in assets. In other words, money can generate revenue and bring profit as long as money is used in real economic activities such as trade, leasing, investments, and other requisite transactions. Transactions which are tied to, linked to, or backed by real assets, services or commodities. The next step. The next principle in Islamic finance is promotion of participation and risk sharing. Well, the ban on interest does not lead to a kind of free and unpaid system. There has to be a link between income and participation in financial transactions, which must be backed again by real assets. Islamic economists stress that the participation of risks and remuneration is one of the bases. It's the foundation of an equitable system, which is Islamic system. The next one. Abiding by comprehensive ethical framework. You may have heard Islamic finance are viewed as ethical or equitable or fair finance. They promote just labor, entrepreneurship, trade, commerce, justice, very wholesome principles. The list, to name but a few. Islamic finance includes tools that serve the socially disadvantaged, for instance, the Qard hasan, for instance, or the zakat, or sadaqah, and waqf, or the Islamic kind of charity. Islamic charity. Therefore, Islamic financial products cannot be inequitable and cannot be steeped in dishonest practices or lead to disputes and conflicts between the parties. One last thing. One last overarching principle of Islamic finance is to promote peace and harmony in a society in which each one receives a fair share of wealth, and which leads to a constructive environment. Again, the goals these are very good goals, and they really suit the needs of our today's society. Let's take a look at the similarities between Islamic finance and conventional finance. First is the outcome. Well, these tools are created to meet financial needs. Meat, let's say take meat as an illustration. There can be karam meat or kaliyal meat, but the outcome is the same. You still your hunger. Next one,
Следующее сходство – это расходы.
costs.
Несмотря на то, что исламские финансы
Islamic finance, although Islamic finance are steeped in or pursue very noble goals,
финансов несут такие же, а иногда и
they
более
face similar or even higher costs
Следующее
faced by conventional finance. The next similarity is pricing.
финансовый инструмент существует на том же
Islamic financial instruments and tools, they exist in the same market, competing with conventional instruments and tools.
другими альтернативными
Their return is comparable with other comparable tools.
сходства.
This is
Что мы хотим сказать, что
this takes care of the
исламские финансы,
similarities.
традиционные финансы, они похожи.
Well, conventional Islamic finance are similar but not identical.
Давайте просмотрим
Let's dive
основные
into.
отличия
Let's
между
walk
традиционными
through.
и исламскими
Let's
финансами.
walk through the
Первое это-
differences.
Как вы считаете, что же,
What
какие
is
есть отличия?
difference number one? What do you
Самое
think?
главное отличие исламских финансов.
What's the difference number one of Islamic finance? Thank you.
Это как бы основополагающее
Yeah,
отличие.
it's the
Что
key
выявляется в
difference.
контрактах, договорах? То есть,
So
насколько
this is
это
what is
соответствует шариату
reflected
или не соответствует
and
шариату,
contained
определяется договором.
in contracts,
Традиционно финансовые
again, which are again
инструменты
compliant,
обычно
or
структурированы в виде
not
процентов,
compliant or non-Sharia compliant.
которые
They are
запрещены.
normally structured as
Ранее
interest-based
исламские финансы,
loans, which are
они
prohibited. But Islamic finance are asset-based
И очень много структур,
and asset-backed.
структур и
There
процессов,
are
которые
various
являются
structures and processes,
второй отличие. Исламские
and
финансовые
they
инструменты
present the
используют различные
second
процессы,
difference.
которые
Islamic finance
владение
rely
определенными
finance relies on ownership, on an active ownership of
Очень
projects.
много структур в исламских
There is a
финансах
plethora of
и инструментов, с помощью которых можно прийти к
and
определенным результатам.
tools and instruments that might take you to the same
Когда-то преподавал креативное мышление в
outcomes. I
университете,
used to teach creative
хочу
thinking
сказать, что
at a
исламские
university.
финансы являются очень
And my
креативными.
point is that Islamic finance are very creative in terms of
Достаточно
product generation, whereas conventional finance are pretty non-creative, pretty mundane.
инструмент, то есть единственный, в основном, единственный инструмент в традиционном.
So again,
И следующий,
this is their
последний,
similarity. This is their difference.
различие, которое мы
And
хотим
the next
заметить, это
difference
использование
we
средств.
want to emphasize is the use
Существует
of
ряд дополнительных условий для
money,
использования денег.
funds. There is monies can be used.
То есть не все деятельности могут
Can be
быть
used.
финансированы.
Can be
Или
used.
же те доходы, которые вы получили с помощью исламских финансов,
Their use is restricted by additional terms and conditions.
деятельность, в вашем праве деятельности
Again, your right to dispose of funds is restricted by Sharia provisions.
Исламские финансы,
So again,
они разные,
Sharia,
отличаются от
the Sharia finance can be very different from conventional finance, but they are not opposed. Finances are not opposed to conventional finance. Different, but not antithetical, so to speak. There is the so-called Sharia governance.
который является важным компонентом
Yeah, it's
исламского.
an important component of Islamic finance.
Кто-нибудь хотел на вопрос, что же такое
Would anyone
шариатское
like
управление?
to raise a hand and just explain what Sharia governance is all about? I'd assume that in an Islamic company and in a conventional company, it's similar structure-wise, like audit, governance, leadership, and all. But the key difference is more like the fact that an Islamic company should have the so-called independent Sharia audit, which passes fatwas or rulings on some financial services and runs annual Sharia audits and its result is like compliance and non-compliance by a company with Sharia provision. The Sharia banking system, they play a function, they have a certain function which ensures compliance, Sharia compliance, which keeps track of the process every step of the way. So the main key of this function or this component or this division is to ensure that given organization is outside the non-compliance risks. What is non-Sharia non-compliance risk? What is it? It's a risk of facing reduced profits due to financial or reputation losses, which are again incurred by non-compliance with Sharia norms. It's reputation that matters in our system of Islamic finance. This is what it comes down to. And should such risks take real shape and form, then we could be talking about impacts, financial impacts and losses, and non-financial reputation-related risks and losses. The key components of Shariah governance. Step one, in each financial institution, there have to be institutional supervisory boards. It's component number one. The next component, there has to be a department which links the supervisory board to the activities and work, like of a given Islamic finance institution, an internal function. The next function is Sharia audit. It must be performed internally or externally. I mean, the compliance. The next one, in a grand scale of things, like in a larger perspective, the Central Sharia Board, which lays out and stipulates the key provisions, standardization in Islamic finance. There are two key organizations, the IAFC, Организация AAIFE, it's an accounting and audit organization that services Islamic financial organizations. It was created in Bahrain in 1991. Its main primary mission is to ensure the alignment and the harmonization of principles between various financial Islamic financial institutions organizations. Has issued a number of regulations. The next one is equally important, is the Islamic Financial Services Board. The Islamic Financial Services Board was founded in Malaysia several years ago. It establishes standards for regulatory and supervisory boards for market participants and regulators. Yeah, but it's more into regulators than market stakeholders. The first one, AIFI, is in Manama, Bahrain, and the second one is located in Kuala Lumpur. It takes care, gives you a taste, gives you an overview of what Islamic finances are all about. And now I would like to give the floor to a colleague of mine, Mr. Ajib Al-Assad. Please, you have a question?
характер транзакций финансовых.
The nature of transactions has an impact on human psychology. Could you please give us, illustrate a point?
В этой сфере все еще ведутся наблюдения и так далее.
Yeah, research is still underway. Research is still underway in this domain.
Больше
So say there is a person who is more involved in in charging interest rates. That person is more prone, has a stronger tendency to develop avarice, to be greedy.
У нас есть система Qard hasan.
We have the so-called Qard hasan system. Say there is a person
Легкую наживу.
who sees easy gain within his, someone who makes easy gain bears no risks.
Она добавляются проценты, да?
Just as time is running, the wealth is accumulating. Like greediness, it's difficult for that person to give somebody a loan, an interest-free loan. That person becomes greedy. I have a friend in England, so they gave a loan. That person lent money to the other person who is a non-Muslim. That non-Muslim person, he was surprised. Why interest-free? Why interest-free? Why are you giving it for no interest? People are not used for.
بسم الله الرحمن الرحيم والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Welcome back. Rahmat for coming back. That's very interesting. It doesn't seem we have lost too much. Maybe one or two. But that's good. That's a good indication of your commitment and maybe that we are presenting something interesting. So following on the first session delivered by my colleague Omid John on the founding principles of Islamic finance, we'll continue now and we will look at the Islamic liability and investment products. So, I will be moving around. If that gets you dizzy, let me know. I can stay here, but I don't like just being fixated, So, let me know. It's a free country. You can express whatever you feel better. I just feel like moving around, trying to see everyone, making sure nobody's playing with their phone, and all of that. So this session, we'll talk about these products: current account, time deposit, savings account, and treasury placement. We have used the names that are used in the banking industry. So we make it easier for everyone to know what are we trying to achieve, right? So current account, transactional account, right? The account that you use in your day-to-day activity, you buy, you sell with it, you get your salary through it. The time deposit, the type of products where you lock your money for a certain time, 1 year, 6 months, 2 years, depending on the products. Savings account is a kind of a combination between current account and time deposit. So savings accounts, usually you get a little bit of return on the funds, but you have the flexibility of withdrawing money from it. Usually it's not a transactional account. So it's not an account that you use for paying, and making transactions. More like, a savings account with instant access to the funds. Treasury placement is more, a type of deposit or placement at institutional level, or sometimes between, a financial institution and a big corporate, or between two banks, sometimes called interbanking placements. So this is the type of deposits that can be very high, very big in numbers, that they can negotiate their own rates at the treasury level. So at the finance department of a financial institution, where they can discuss and create something, bespoke. So let's start with current account. And this is structured on a contract called Qard hasan. Now, you will notice in Islamic finance that, there will be a lot of Arabic terminologies. But then we will simplify these Arabic terminologies and tell you, what does it mean? So Qard Hasan, in very simple terms, it's interest-free Islamic loan, right? So this will be used to structure a current account. So in a sense, when the clients are depositing their money into the financial institution, we're calling them the IFSP, the Islamic Financial Service Providers. They will be effectively providing an Islamic interest-free loan to this institution, right? So the depositor will be the lender and the institution will be the borrower. Now you will tell me, okay, so that's what happens in conventional finance. What are you guys inventing? Right, so a little bit, give me some patience and we will see. So one of the key features of a conventional overdraft that they will let you go into a negative balance, right? Usually, it's called in finance overdraft. In Islamic current accounts, there are options to do this. First option is bank close this. It's not you cannot go to negative balance. That's one option. Some banks or financial institutions, what they will do, they will let you go to a negative balance, but then give you 24 hours to close it, interest-free, nothing to be paid. Others, they add a penalty. If you go to a negative balance and don't close it within 24 hours, there will be a penalty, right? Now you will say, oh, now you're changing the names. You don't call it interest, you call it penalty. We know with this Islamic finance tricks. Okay, let me explain. First of all, this penalty is not an income to the financial institution. So even if they apply it, right, they will take it from the client and they will put it in charity. And this is why it's important to have the structure that John explained, the Shariah Governance. There should be an auditor that check if a penalty applied, the bank did not benefit from this. Because technically this is riba, right? So we're not playing with the names. But sometimes you can get this type of customers where they just, take the money and exploit because the bank is Islamic, they will not charge me, I will take the money and so on. So this is one of the ways it's being done, right? From a Sharia point of view, scholars usually add this in the terms and conditions as a promise by the client to donate, right? So essentially the client is being forced to donate, right? Some scholars don't like this. They say, no, you should not do this. But essentially, there are situations where we have to do it. So that's first difference. Overdraft is not allowed. Second difference, the money in conventional finance can be used by the bank in whatever they want. In Islamic finance, it can only be used in something halal, something Sharia compliant. Right? So that's a very important difference. So sometimes people think, I'll open a conventional current account, I don't take interest, it's fine. Right? Yeah, some scholars would say this is fine, but you have to think of what is your money doing. If your money is being used to assist interest-based financial transaction, then there is a problem, right? I'm not saying using this kind of account will become completely haram, because there are differences of opinion about this matter. But it's better to find something, to help you in putting your money as a current account in Sharia compliant way, or minimize your balance and put the rest in an Islamic savings account. So, because this is Islamic interest-free loan, the bank, the financial institution, they can use the money at their own risk, right? So they can use it, whether they make a profit or loss, it's their problem. But it has to be used in something Sharia compliant. And if they incur a loss, the client will not have any responsibility because they are not even making any form of remuneration, right? So the Islamic interest-free loan cannot have a profit on it, right? So don't confuse the word loan in Islamic finance only means Qard Hasan. The word finance could mean many things, right? So in the industry, when you see somebody saying Islamic loan, they are either not aware of the right terminologies or they have got the whole thing wrong, right? So when the term loan used, it means only one thing in fiqh, Sharia standards perspective, and that is Qard Hasan, Islamic interest-free loan. But when you say Islamic finance facility, Islamic finance instrument, then it can be structured differently, and there can be a remuneration based on the structure used. So of course, being a current account, the clients will have the typical safekeeping services by the bank. They would have access to maybe have a checkbook, and the IFSP, the Islamic Financial Service Provider, the IFSP will be able to charge certain fees for providing services, right? Is this riba? Do you think if the IFSP charge fees for services, that will be construed as riba interest? Do you think so? Let's say giving you a checkbook, giving you access to online banking, maybe monthly fee for maintaining your account. That's fine. Thank you. So, first of all, remember, in this relationship, the bank is not the lender. So if they get money, it does not qualify as riba, right? But there have to be justification for this money. So a service like giving you access to online banking, some banks charge for it, others don't, right? Giving you a checkbook, some banks don't, others could charge. So we have to keep in mind. In all cases, any fees, I'm not talking about interest charges, any fees for provision of services applied on these accounts has to be reviewed from a Sharia point of view by the Sharia Supervisory Board. Remember this school, group of scholars that John described, where each Islamic financial service provider needs to have them. In some jurisdiction, it's allowed to have one Sharia scholar rather than a Sharia board. But generally, the standards are always to have a Sharia board of 3 Sharia scholars. You could have more than 3 Sharia scholars, by the way. John, you're taking too much photos. Thank you. I'm concerned about my battery. No need for translation for this part. Islamic saving account. So this one will be structured on the basis of a term called Wakala. Do you have the word Wakala in Kazakh? Do you use it? Wakala? You don't use it. Oh, it didn't work. Sometimes, wakil. No wakil? Nobody use wakil? Wakil. Okay, I give up. So wakala is an Arabic word. It means literally agency. Right? So now we will see how we can structure a savings account based on agency. You might be thinking, why these are called Islamic finance contracts? They are things that we do in our daily life, right? And this is sometimes Islamic finance practitioners complicate things for people, right? The reality is all these were contracts used before Islam, most of them. When Islam came, Islam provided regulations, guidelines to govern these contracts, right? But people before Islam used to lend each other money. They used to buy and sell. They used to have, agency between each other. But Islam came and put guidelines aimed at, ensuring fairness, ensuring no exploitation, ensuring clarity of terms and conditions, right? So this is why when they are used in Islamic finance, I think they kept using these Arabic terms maybe for blessings to make the clients feel this is. But in simple terms, this is agency. And the bank or the client is assigning the Islamic financial service provider as their investment agent to invest their money in Sharia compliant halal activities for achieving a target profit rate, an expected profit rate. Right? And yes, don't ask me, it can be represented by a percentage. There is nothing haram with a percentage, please. Stop thinking that if you see a percentage, oh, this is riba. Percentage is number. Percentages don't bite. Percentages can be used in Islamic finance, right? Numbers, because, imagine if you are a customer and you want to deposit your money. If you go and you want to compare your options in the market, How can you compare this without having percentages? This is for your own safety, to know what can you expect, right? What is the problem is when you have a haram contract, interest-based contract, to create an interest rate that will generate haram income. If you have an investment agency contract, that money will be used for a target expected profit rate. That expected profit rate is not contractually guaranteed. So the IFSP will not tell you, Wallahi, I swear by Allah, you'll get this money. You know, they would not say this. They would say, we expect to achieve this profit rate. And they will achieve it. You know why? Because they have been doing this for years. They know how much they make. They know how much they need to live for their operations, and they know how much they can afford to pay you, right? So the client will give the money to the IFSB, assign them as their investment agent, and they will invest the money in Sharia compliant activities and give an expected profit rate, right? Now, the money with the IFSP cannot be guaranteed. Why? Because, you know, from a Sharia perspective, let me tell you a little bit of an Islamic fiqh term. It's called, the investment agent has what is called yadul amana, a hand of trust. So they are entrusted to manage these operations. As long as they fulfill this trust, they do what they are supposed to do, they comply with the terms and conditions, there is no negligence, there is no misconduct, then they do not have to guarantee your money. But imagine if the bank was doing some fraud, or the management was not investing the money prudently, then in this case, they have to guarantee the money, right? So that's a little bit of overview. So let's look at the process quickly. This is the client, the IFSP. So the client approached the IFSP, you know, ask for opening a Wakala savings account. The IFSP, you know, give them the offer, okay, we accept, you know, you open this savings account with us, you can have access to your money whenever you want. The expected profit rate, let's say, is 10%. Then they agree on this, sign the terms and conditions, the client accept, they agree on all the particularities of the agreement, and the money then invested in Sharia compliant activities. Right? So this money will be used, unlike, you know, think about this as a normal conventional account. The contract will be interest-based contract. Your money will be guaranteed. Your profit will be guaranteed. Your money will be used in interest-based transactions. Congratulations, you've done everything haram. Right? You do this product, your contract would be Wakala, investment agency agreement, Sharia compliant. There will be somebody experienced, read this contract and told you this is halal, right? Your money is not guaranteed, but is protected. You know, I'll talk about protection versus guarantee in a little bit. Your profit is realistically achievable, but not guaranteed. Your money will be invested in a halal way, and you can have a halal income on that. So, subject to performance, so let's say the bank is profitable, everything is going well, then you'll get your expected profit rate. Let's say the expected profit rate is 5, and the bank achieved 8, right? So how much the client will get, 5 or 8? 5. What will happen with the 8? Thanks. So the 8 will be given to the bank as a reward for their performance, right? So they achieved 5. The agreement says anything over 5 is mine. Otherwise, how can the bank make profit, right? So that will be the agreement. And this is where the IFSP retains any profit achieved over and above the expected profit rate. Any questions on this? No questions. So the legal documentation of this contract, of this product, will be called usually, Wakala terms and conditions, Wakala special terms and conditions, which can be designed by the IFSP in line with their, structure of documentation. Whether the client have to open a current account first, then a savings account, or they immediately can, have a Wakala savings account. It's flexible. Now, we look at Mudaraba. Have you heard of the term Mudaraba? Do you know what does it mean? Thank you. Partnership. What's your name, Aka? Sanjal, mashallah. So partnership between who? Between the bank and the IFSP and the client. So to do what? Thank you. So it's actually to make investments where, need to put this here. I think I'm making it difficult for the gentleman doing the video recording, going back and forth here and there. So sorry. So Mudaraba, as rightly mentioned, it's partnership, where the client assigns, or the client and the IFSP enters into a partnership, and the IFSP, so I'll stop saying bank, financial institution, we'll just agree on IFSP. Whenever I say IFSP, you'll know it could be a bank, it could be a microfinance company, it could be a leasing company if it's a deposit taking. I don't think usually they are deposit taken. So the IFSP under this partnership will be the managing partner, right? They do not contribute by money, they only contribute in managing this partnership, and this partnership is aimed at investing the money of the client in Sharia compliant activities, and that is the deposit, the time deposit. So just like what we have seen with Wakala, the IFSP, sometimes it's called in Arabic Mudarib, right? So the one who is actually managing the business, the term is Mudarib. They cannot guarantee the same thing. They cannot guarantee the capital. They cannot guarantee, the return on the capital unless, cases of negligence, misconduct, non-compliance with the agreed terms and conditions. And they have the duties and responsibilities to manage this, prudently, to, make sure that the money of the client is not put in too much risky investment that they should not, basically lead into losses. So the first step, the client goes to the IFSP, ask for a time deposit. It could be 1 year, 2 years, 6 months, and sign a Mudaraba agreement, Mudaraba terms and conditions. IFSP is the partner that is managing the investments. The clients are providing the money, and they agree on a profit sharing ratio. Right? So let's say whatever profit we achieve, we split it 50-50. Right? But then for customers, it doesn't mean anything. So what does 50-50 means? So usually regulators ask, the IFSP to define a percentage that they believe it can be achieved as the percentage would be as a percentage of the capital provided, as percentage of the deposit amount. So they can compare different products, right? I will not go into too much details about the calculations and the reserves, because there will be some reserves to protect the capital and so on. That's too much for this session, but in the guidelines, you will see all this information. So the IFSP will invest the money in Sharia compliant activities. Usually it's financing to other clients using Sharia compliant contracts and arrangements. And at the end of the term, it could be 1 year, 2 years, the bank or the IFSP will be doing their calculations, see if the profit has been achieved. They pay the client their share, and the IFSP would retain their profit share, right? Overall, Wakala has become much more popular because it's simpler to manage than Mudaraba. Mudaraba, with profit sharing ratios and this and that, it becomes more difficult for clients to understand. So, the industry is moving towards investment agency type of products. By the way, these products are used in Muslims and non-Muslim countries. I came from the UK, and back in the UK, we have 2 full-fledged Islamic banks. So these banks only do Islamic financial transactions, and I think over 10 institutions that have something, you don't have it here in Kazakhstan, Islamic windows, where they can offer conventional and Islamic products by having a proper segregation systems internally and so on. So there's around 15 companies and financial institutions providing these products, and You know, this Mudaraba and Wakala are used in the market. And one of the banks is called Al-Rayyan Bank. They said, you know, for some of their fixed Wakala fixed savings products, fixed term savings products or time deposits, 80 to 90% of the clients are non-Muslims, British non-Muslims, right? They like the product, and you know, when the banks is approaching the clients, they are announcing they are also ethical, so your money is not invested in activities that are not ethical. Some of the banks in the UK are also signed, you know, what is called the responsible investing principles of the United Nations, if you have some background or idea about them. So it's an ethical product, and you know, they are getting the return, and the bank's actually competitive. They are offering better returns than conventional, at least on the, you know, deposits products. And on top of this, in some occasions, the banks were smart to give more than the expected profit rate. So your conventional bank will never do that. Right? They will tell you interest rate is 1%, you'll get 1%. So some occasions they gave more than expected profit rate. And so that was a little bit interesting for customers, refreshing to see the bank giving more than they have agreed. Legal documentation of this will be, you know, Mudaraba terms and conditions. Because these are deposit products, you will not see a lot of terms and conditions and contracts and so on, right? Because this, you know, when you are giving the money to the bank, they will make you probably sign one contract. You ask them to give you money, conventional or Islamic, you'll probably see this thick of documents and collateral and security and so on. So same story in Islamic or conventional finance, documentation can become more complicated when the bank give you the money. And don't blame them for this, because they are using other people's money, right? So they are trying to protect their depositors as well. We finished this, right? Oh no. So this is an example of how the calculation will be. This is what I told you, the industry moved to Wakala. So if you look here, you know, you get deposits from the IFSP, from the clients, and then the IFC manage the money. Then you have, let's say, you know, 1 million, you know, 1 million is too little, maybe 100 million tinges, you know, as a gross income from the activities. Then you have some deduction of expenses and costs for operating this. So let's say 10%. So now we have, you know, net income of 900,000 tenge. Then, you know, profit equalization reserve. This is a reserve usually IFSPs, you know, create to protect and to stabilize profit payments. So if you, in this quarter, do not make as much money as expected, you can top it up. So protect the, you know, the depositors. So this is another 10%, 10% of 900, that's 90,000. Then you will have a Mudaraba profit of 810,000 tenge. Hope I'm not making it difficult for the interpreters with all these figures. Now we have another, you know, basically deduction. So let's say the profit sharing ratio is 50-50. So the IFSP will take their share, which is, you know, 405,000 tenge. Now we have 405,000 tenge ready to distribution, but we do not distribute them yet. We create another reserve. You see how much layers of protection. We create another reserve, but this reserve, the objective of it is to protect the deposits from losses, which is another 10%, for instance, of the 405. That's like, let's say, 40,500. That means we have around, you know, 380, 370,000 ready for distributions to clients. Then the bank will look how much is their expected profit rate. They will give it to them. Anything left, the IFSP will take it. So it's a lot of calculations. While, you know, Wakala is very simple. You achieve 10, you know, you take 3 and we take the rest, for instance. So, Treasury placements. Now, this is a very interesting product. This is called commodity Murabaha. And in brief, it's a type of, I would say a little bit controversial product, usually created by banks to facilitate, provision of financing with fixed guarantees income. And in the context of deposits, it's used to achieve, a fixed return on a deposit, fixed guaranteed, by using a contract called Murabaha. Right? So Murabaha is a profit disclosed sale where one party will sell to the other party something and disclose how much is the cost and how much is the price. Right? So imagine, somebody asked me to buy for them, a car, and I buy it and I say, okay, I'll sell it to you on Murabaha basis, where I bought it for, 1 million tenge, and I want a profit of 10%. That's 1,100,000. And then after I buy it, I own it, I can sell it to them with a profit, right? So that's in brief how Murabaha works. So let's see how it will be used as a treasury placement. So the client places funds with the Islamic financial service provider, and agree on a profit rate. So let's say, in this case, we are talking about between two different IFSPs maybe, or a big corporate and the IFSP. And they say, I want a profit rate of 12%, fixed guaranteed. So once they agree on this, the IFSP goes and buys something the client doesn't need. Let's call it, usually they would use metals. Things like, they can, palladium, they can use copper, right? Non-precious metal, not gold and silver. Right? Gold and silver, they are subject to certain riba rules. So they will go through a broker and they will buy, let's say, 1 million tinges worth of copper, right? But they will not bring it to their head office. They will pay the money and they will get a certificate of ownership, and that copper will be stored somewhere. Could be in a warehouse. They will define all of this, right? Now, who owns this metal? The IFSP, right? So they will go and sell this metal to the client with a profit margin. Sorry, they will go and offer to purchase this metal from, I was thinking of commodity Murabaha on the other way. So the IFSP would go to purchase the metal from the client. So basically in this first leg, so I don't confuse you, in this first leg, the IFSP, they will act as an agent of the client and they will buy this metal on their behalf, right? So imagine, Omid John, he is rich, mashallah, very rich. He has like 2 million tinges and he wants a guaranteed profit. He comes to the bank and I say, I have this money for you. For 1 year, I want 20% profit rate. So they will say, that's fine. Assign us as your agent. So I will act as Omid John's agent. I will go and buy, 1 ton of copper. That is worth, 1 million tenge. Then at this point, Omid John owns this copper, right? So Omid John will say, okay, now I have this copper. I will sell it to you as an IFSP for 1,100,000, right? So both of us don't need the copper, but I accept the IFSP to buy this copper. I take it. Then what I want to do with it, I will sell it to get the cash so I can invest the cash in my activities. And then Omid John gets a fixed return. So after 1 year, I'll pay the price. I know the structure is complicated. And this is why, it's controversial. According to the Sharia standards of IOFI, you remember IOFI, I mentioned, Omid John mentioned this, standard setting body. This structure should not be used unless the law does not allow you to do something else, or the regulations do not allow you to do something else, or sometimes in cases where the bank in distress and they may lose they may go to bankruptcy or so on. So in these cases, they will allow to use this, and subject to strict conditions. There should be ownership, there should be, clear, documentation of this process to make sure there is a purchase and sale transaction all in the right time, right? So you don't have to, think about it. I'll tell you in simple terms. It's just like, you need money. You go to the market, you buy a mobile phone, and the mobile phone you will pay on a credit. They will tell you, you take this phone now, and every month you pay, 100 tenge, right? Or 200 tenge or 500 tenge. But you don't need the mobile, you don't need the money. You take the money and you go to the market and sell it. You get the cash and use it. So this is a similar way, right? You still have made purchase and sale and all of that. The difference here, it's more organized. What you have done when you bought the money, it's more, free market. So the documentation of this, you can imagine there will be something called the commodity Murabaha agreement, an offer letter, acceptance letter, purchasing the metals from here, selling here. But now, there are some providers, they do use technology to facilitate all these transactions in minutes, right? We, as IFAAS, do not recommend this product usually to be used, right? So Wakala is more, I would say, organic, right? But, in certain situations where you cannot use the other products, then something better than nothing. So now, we will look at some of the finance products. Yes, please. You can leave it with you, John.
I wanted to ask a question concerning these restrictions and not recommendation to use this commodity Murabaha. As I know, the commodity Murabaha is also used in opposite way.
Yes.
When the bank provides money to the lender, and so does this recommendation not to use this commodity Murabaha apply to both types of, when bank takes the money and pays not interest but the markup, and when the lender is paying this markup?
Thank you. That's a very good question. Unfortunately, you may not like the answer, but it remains the same. Whether used as a finance product or as a deposit product, the standards of IOFI clearly says, this should not be a standard product. It should be used only in cases, of liquidity issues, of law, and regulations barriers. Otherwise, it should not be used as a standard product, right? Having said that, that doesn't make it haram, right? We have to be clear about it. It's more like, from a Sharia non-compliance reputational risk for the public, especially at the retail level, it just shows them, because at the end of the day, this product, in the scholars call it hila. It's a trick, a last resort to try to abstain from riba, right? Now, generally speaking, this product would have been okay if it was not organized. Meaning, some banks in the UAE, what they would do, they would buy, for instance, government-issued Sukuk or Islamic bonds, which are usually very stable in price, and then buy them, own them, and sell them to the client with a profit margin. And they will leave the client with them. The client, if they want to have them, they can have them. They can issue them, they can give him the ownership. The client maybe can sell them later on after one day. Maybe the client will sell every day a little bit. Or the client can ask the IFSP to help them in selling them. Right? That's called non-organized tawarruq, or tawarruq, just in general tawarruq. Right? Here, the concerns of Sharia scholars are removed because you are not obstructing ownership and access to the asset. right? Even if the client wants the money, but the fact that commodity murabaha is organized in a way that you cannot technically have access to it, even if the contract says does not say this, but you cannot bring commodity in London warehouses, bring 3 tons of copper to a client in Kazakhstan, right? So there are different ways of doing this, but it remains, the context always have to be taken into consideration. An emerging market, maybe like Kazakhstan, the Sharia scholars would look at this differently. But as I told you, Sharia scholars usually, many of them say it's fine. AIOFI looks at it from an industry perspective and say we should not, popularize it. We should not let it be the product. Right? So if somebody wants a car, you say, okay, I will buy for you a copper. I'll give you the money, you go buy a car. Why? Just buy the car and sell it. Right? So sometimes, I'm sorry to say this, but sometimes banks get lazy. I don't want, let me do this commodity murabaha. I have my brokers, I have my stuff, I don't want to do anything. So we have to achieve that balance in looking at it. And I'll give you an example here, how to use commodity murabaha as well. The beauty of Islamic finance is so diverse, it fulfills many needs. But there are certain situations where commodity murabaha can be the medicine, right? But not the standard. I hope my khutbah was not too long and clarified the issue.
Thank you.
Ahmed. So let's start with auto finance. Auto finance, everybody knows. You want a car. I just explained the product. The client wants a car. The bank goes, buy the car, own the car, sell it with a profit. Right? So Murabaha, as we have explained, it's a profit disclosed sale. So the IFSP and the client, the IFSP, the client. So let's take Omid John as an example again. Sorry, Omid John, I have to keep using you in my examples. He wants to buy a Mercedes. As you know, he's very rich, mashallah. So he goes to the agencies. He sees different cars. He likes a car, right? And then he goes to the place and say, okay, I want to buy this car. Give me a quotation, right? He doesn't buy the car. Keep this in mind. He just gets a quote. And they give him a quote. How much the price of the car? He goes to the Islamic bank now and give them the quote and say, I want to buy this car. So the Islamic bank will buy it for him, will own it. Then they will sell it to Omid John with a profit, right? Sometimes to mitigate the risk of Omid John not buying it, they will make him sign an undertaking to purchase. Right? So I undertake to buy this car once you have it. By the way, this whole process, as IFAAS, we have partnered with another company and we have created a fintech solution called iFin, where, if Omid John wants this car, he doesn't have to go to the bank. When he is in the Mercedes agency, through that fintech, he can buy it in 20 minutes. So we're trying to come up with solution also outside our work as advisory to, streamline this process, but ensuring Sharia compliance by using a software that can be linked to the core banking system through an API, let's say through a link, right? For ease of translation with the core banking system of the bank and streamline this process. So now the client, the IFSP purchased the automobile from the vendor, and then IFSP offers to sell this automobile to the client on a Murabaha basis, where they give the client immediate ownership, right? And delivery, and the client will pay on installment basis, right? In 1 year, in 2 years, and so on, as the time, goes on. Now, some people say, oh, this is like conventional loan, right? You are making money from more money. But no, if you know how many laws you need to change to do this transaction. You can ask Medina. She worked on this with the government and the National Bank. The bank by law is not allowed to do trade. The bank is allowed to do lending, and Islamic bank is allowed to do trade, right? So you have to change the banking law, the tax code, so they don't look at this as 2 separate transactions. All these changes, and people come and say, oh, it's the same. I wish the regulator said it's the same and we don't have to change all these laws and the regulations. It's not the same, right? So the bank is actually taking a risk of ownership, even if it's for a split of a second. The bank is fixing the profit. A conventional bank, you fix the money, you agree, you don't have money to pay, you delay the payment, then the money will increase, more interest to come. For the Islamic bank, they cannot make, you know. So you buy the asset, you add your profit, you sell it, end of story. And if this process does not happen in this way, so if the IFSP sells something they don't own, the whole profit of this transaction becomes non-compliant. So legal documentation, you will have maybe a promise to purchase from the client, you will have the Murabaha contract, you will have some security agreements to conclude this. Now this is the personal finance commodity Murabaha. Yes, please. Yes.
IFSP take this car as a collateral.
Yeah. Don't, you know, collateral meaning keeping it as a security.
Yes.
But don't lock the car in your branch and say you cannot use the car, you know. So collateral, yes.
I mean, if the client cannot repay, they just can take this car back.
When something like this happens, this should be raised to the Sharia Supervisory Board, and the Sharia Board will study this case by case. And based on the client's circumstances, then the Sharia Supervisory Board will make an opinion. But in general, if the client, you know, when you sell the car is the client's car, right? But then there is debt to be paid by the client. And that debt is the right of the bank, the right of the IFSP. So if they have a legal charge over the car and they can take it to get their money, that's okay, subject to the laws and regulations in the country. Can you do this, right? Because at the end of the day, you know, this should be a last resort. But from a Sharia perspective, this debt needs to be paid, right? And by the way, anyone knows what is the longest verse in the Quran about? What is the topic of the longest verse in the Quran? About? Debt. Thank you. The longest verse in the Quran is about debt. It's in Surah Al-Baqarah. It's almost like a page. It's like a procedure about debt. Right? So this is how sacred debt is. And people think, oh, you know, this Islamic bank should be tolerant with debt. You know, if somebody pass away, they die, and they have debt to be paid, the imam is not allowed to do their janazah, their death prayer, until their debt is settled or somebody accepts to take that responsibility. So it's not only we ask for protection from a financing side, but we have to make sure that we give people their right on us, right? So, you know, it goes both ways. So commodity Murabaha, just like the same product we have, but we have to switch the whole thing. So what is here? The client wants money, right? If the client wants money, then in this case, we have to create a transaction where the bank can make money. So the bank has to buy something. So they go to the broker and buy the metals. They own the metals. Let's say the client wants, you know, 500 tenge, right? They buy copper worth 500 tenge. They sell them to the client. The client say, oh, I don't want 500, I don't want 3 tons of copper. I want money. And then the IFSP said, that's fine. You can assign us as your agent. We'll sell your copper for you. They'll sell the copper. They get the cash, 500. They'll give it to the client. At the end of this transaction, you know, the client gets the money. They can use it in fulfilling their needs. So somebody wants to get married, right? Poor guy who wants to get married. And I'm not de-promoting marriage and that's a joke. I'm married, alhamdulillah, so don't get me wrong. So a lot of money to be paid, right? So he goes to commodity Murabaha, right? So what he's going to do with 3 tons of copper? So they give him this copper, he goes and this will be sold in the market, just like the mobile example, right? He goes and get a mobile he doesn't need, but he gets the mobile, sell it, makes a little bit of loss, and then use the money for, you know, paying the mahar and, you know, paying a fridge and all of this stuff. So the legal documentation, you can imagine there is a promise to purchase, there is a Murabaha contract, there is a purchase contract, you know, like a big list for this. Machinery finance. And this will use the contract called Istisna. You know, machinery finance, let's imagine a client, a factory, they want to buy a machine. right? They don't have the money to buy it cash. So the bank can use this contract so that the machine does not exist. It's a bespoke machine. It has to be designed specially for this client as per their need. So they will use this contract called Istisna, where the bank can act as a manufacturer and accepts to do this contract. And you will tell me, okay, so how can the bank really do this? You know, it's not the bank's business. So what imagine, we'll go back to Omid John. Omid John, mashallah, is very rich. So he wants to buy, you know, a machine that is designed bespoke for his, you know, I don't know, you know, shirts factory, right? So he looks online, he finds a Chinese guy, you know, this factory in China, they will say, okay, we will do this machine for you. This is the price. He get the quote. He goes to the bank and say, this is the guy I want to buy the machine from him. You know, this is the quote, help me do this. And then the process starts. So the client and the IFSP, they will sign an Istisna contract. So Munjon will sign a contract where they will they will buy a machine from the bank, let's say for 10 million tinges, right? In 6 months time. They agree on the payment terms. So Imagine will say, I will pay you now 10%, and then every 6 months you will pay me this, and so on and so forth. Then the IFSP will have something called parallel Istisna. So another Istisna contract with the Chinese guy, but the roles are reversed. So now the IFSP becomes the, you know, purchaser of the machine, and they agree on the technical terms, they agree on the price and all of that, and they sign the contract, right? So in this case, they have to make full payment to the machine supplier, because the machine supplier will not start working until they get the money. And, you know, let's say after 6 months, they deliver the machine, and then after 6 months, this machine will be given to the client. Of course, you know, this is not like loan, right? So the bank is taking risks, but they can manage these risks by making sure the terms and conditions of this contract and this contract are similar. So if the bank has to deliver this machine in 6 months, the vendor has to deliver this machine in 6 months. The specifications are the same, right? In case of delivery, in case of late delivery by the machinery vendor, maybe there is a penalty for late delivery. The same penalty can be reflected here. So the IFSP can mitigate that risk, right? This is a penalty for late delivery of the machine, right? Not a penalty for late payment, right? So just be clear of this. This is not riba. So you can imagine the legal documentation. We have Istisna contract here, parallel Istisna contract there. You'll have probably the collateral documentations, facility letters, and so on. Salam, agricultural financing. This is an overload of information. The objective here is to overload you. But we want to give you a feeling of each structure, right? If I want to do this properly, we will need like 2 weeks. So this is why we have this products guidelines. So you can have details, you have the information with you. If you look at all these documents, you will see for each contract, what's the meaning of it? What are the key features, terms and conditions? What is the process flow? What are the risks? So don't worry. The objective here is to give you a flavor. It's actually a teaser to make you excited, incentivized to look at the guidelines, right? So you will get the guidelines back with you home. You will not get me, right? So just to make sure it's clear, because we're running out of time. So Salam is an Arabic word, and it's used to describe a contract similar to Istisna. You need something that does not exist at the moment, and you need financing for it. But this is in agriculture usually, in the context of agriculture. And also sometimes it can be used in the context of natural resources, you know, extraction of oil and other type of resources. So one of the key conditions of Salam is, you know, with the minute you sign a Salam contract, the one who is buying, let's say, you know, coming back to our friend Omid John, I think after this video, Omid John, you'll be famous, mashallah. So, you know, in this case, you know, Omid John needs money, unfortunately. So he needs the money and he wants financing from the bank. And what he will say to the bank, I have a big field of oranges. But in 6 months' time, I can get the oranges and sell them in the market. But now they don't exist. They are still, the trees are there, but the orange will still need 6 months to grow and be ready for, be picked. So the bank, they will sign a Salam contract with the bank where John will get the money to continue growing the oranges. And when the oranges are ready, they will be given to basically the bank. But the bank, of course, has to find a way to make a profit from the oranges. So John will say, don't worry, I can help you with this. I have one of my clients who wants to buy these oranges. I'll put you in touch with him and then you can maybe conclude the transaction with him. So now you find a client. So let's say I will pay to John as a bank 1 million tenge and I will sell it to the other factory for 1,200,000. So this is in simple terms. You sign a Salam contract and then immediate payment. So this is one of the key conditions of Salam. You have to pay the price immediately, full payment, right? So the client gets the finance amount. Then, the client delivers the oranges on time, right? So what the bank wants to do with the orange, they will sell it using a outright sale contract. Outright sale contract means immediate. You give you the money, you give me the oranges, right? There is no deferred payments and so on and so forth. And the end buyer will give immediate payment to the IFSP, and the IFSP will give the oranges to the factory that wants maybe to do orange juice. So as you can see, the Islamic financial service provider is involved in the real economy. As John explained to you, you have to be, they have to unsleeve and be involved in the economy. It's not just give the money and we are out of it. Of course, that doesn't mean you take unnecessary risks. So the Salam contract and parallel Salam contracts, they have to have similar terms and conditions. So we have to define what type of oranges, what is the quantity, what is the price, time for delivery, and so on and so forth. Legal documentation, if you look here, Salam contract, outright sale contract. Sometimes the IFSP, to make sure they can sell this, oranges, they may ask this end buyer to sign an undertaking, a commitment that they will buy the orange once it's ready. Otherwise, it might be too risky for the IFSP not to know that there is some certainty to sell this.
What if the buyer does not have money? In this case, how will the risks be mitigated? In other words, the buyer is supposed to buy oranges immediately, here and now. What if he doesn't have the money?
That's a very good question. The question is, if the end buyer doesn't have the money, what the IFSP can do. So this is why, I mentioned one of the controls, the risk mitigations the IFSP can do is before they enter into this whole process, they have a signed undertaking from the end buyer that they will purchase this oranges, let's say with this price, right? Now, they don't have the money. The IFSP goes and tries to sell it in the market to someone else. If they get their money back with the profit they wanted to achieve, the story is over. No problem. Now, if they make a loss because the end buyer did not fulfill their promise, they can come back to the end buyer and ask them to pay the difference. Right? So you have promised me to buy this to me, for instance, for 1 million or 2 million. And because of your, default on this promise, I have made losses. So they are not supposed to make extra profit from him just to recover their loss. Right? Maybe they don't have money to pay, 10 million tenge, but if they make a loss of 100,000 tenge, then the end buyer, should buy it, should pay for it, right? So imagine it's just like, there might be other ways of covering this. So for instance, you can also ask the client to sign a guarantee of the performance of the end buyer. Right? You can say to the client, you have proposed this provider, not me. You told me this guy is good. So I want you to sign a guarantee that you will be the guarantor in case the end buyer does not fulfill their commitment. Right? So this is another risk mitigation the IFSP can do to manage this risk. Right? But remember all the time, they should not profit from this. They should just achieve whatever the agreed price is.
Я хотел задать вопрос.
I have a question. In the beginning of lecture, you said that one of the principles of the Islamic funding was the presence of commodity. How does the Salam contract comply with that principle? That is first question. And second question, profitability in Islamic deposits is lower compared to conventional bank. How can we increase attractiveness of Islamic funding deposits, taking into consideration international practices? Thank you very much. In regards to the fact that each transaction must be tied up to an asset, if you take a look at the presentation, it is written there that the transaction must be covered by an asset or tied to an asset. So, in other words, in our situation, there is a certain product you want to buy. You want to buy a product.
Your first comment is very right. And John is right? So we mentioned it's called asset-backed, asset-based, asset-linked. So there is a ring to an asset, but you raised an important point. At the time of signing the contract, the asset doesn't exist. And this applies not only to Salam, by the way, it applies also to Istisna. Right? And Sharia scholars, they consider Salam contract and Istisna contract as the exceptions of this rule. Existence of the asset at the time of contracting for wider benefits to the society. From a Sharia, the term used, the fiqh term used is al-maslaha al-mursala. Meaning, sometimes you have to overlook, from a Sharia perspective, certain rules for a wider benefit, which is in this case, most of farmers struggle with funding until they, get this particular, crops ready to be farmed. So maybe they would need to spend for 9 months, for 10 months, for 12 months until they get the money and sell. So this is why, under Salam, you cannot do this under Murabaha contract, right? So you cannot sign a Murabaha and you say the asset will exist at some point. But under Salam and Istisna, because of the need and the benefit, Sharia scholars have put exceptions for these two contracts, subject to certain conditions to minimize the gharar. Remember the gharar? So, for instance, you have to define what type of oranges, right? The quantity of the oranges. You cannot say, I will only get orange from this piece of land, because this piece of land could be burnt, right? So you just say, I want to have the Kazakh, the Almaty orange, right? For this quantity, for that specification. So reduce the gharar. Now, in case at the time of delivery, the farmer was not able to deliver because, let's say, storm has came and has hit the whole crops and they cannot deliver. Usually, there needs to be, in this case, a Sharia-compliant insurance cover, a takaful cover to protect the farmer as well. This is one of the risk mitigations, right? That sometimes in some markets, they don't do Salam because this type of coverage is not there. And that risk is real. So in this case, the farmer still, from a contract point of view, has to deliver the crops. So they need to go to the market, buy as per the specifications, and deliver. Right? So that's one thing. In the Istisna context, it's something bespoke. Right? Imagine you want to build, the Astana sphere. Right? This is not something you can find ready. It's something very bespoke, designed in certain conditions, and for these purposes, it's allowed, but subject to defining how many flow, what the material will be. Sometimes you can have a technical appendix, of 30 pages, 20 pages, describing how the machine will look like, right? And that will be designed specifically for this purpose. So I hope this answered the question about, this exception. and that it still falls under that it's, asset-backed, asset-linked. It's not asset-backed in this case, it's linked to an asset that will come at certain point, but it breaks the rule of you cannot sell something that does not exist except for Salam and Istisna. And you will see this, by the way, in the guidelines, inshallah. So in the guidelines, I didn't want to go to that level of technical details, but I'm pleased and happy to see the questions. It may need more of your time. I'm happy to stay here till 9 in the evening if you want to ask more questions and go for more technical details, but I think Medina wants to leave earlier and the rest of AIFC team. I remain available for more questions. Your second question about the deposits rates, this is a question of market specific. It's not Islamic finance problem. Actually, the problem that you will see more is the cost of financing is more. And this has to do with many factors. Like, I'll give you an example in the UK. In the UK, Islamic deposits are always given more money, not always, 99.9% of the time, they are given more money to depositors. This is why non-Muslims are using them. But, if you are a banker, you would know that liabilities and assets, you have to match them. So you pay more on deposits, you have to charge more on the assets. So similarly, you have the same problem in Islamic finance, how to manage this. So when you have, a developed liquidity system, so you have interbanking placements, you have access to liquidity from the national bank, the central bank, there are Sharia compliant bonds, Sukuk, you have, Treasury bills, you have a liquid market, so it becomes cheaper for the bank to get funding, and they can, offer deposits, on a lower rate or a higher rate. So this is more of a question of how they can attract liquidity. Maybe in Kazakhstan, they are offering less because they are not able to access cheaper liquidity, right? So, and they have to remain profitable so they can be sustainable. So this is pretty much an ecosystem question, not a structuring problem. Like Wakala does not ask you always to pay less than the conventional product. It's the market conditions. Clear? Ahmed. So, Mudaraba, we have discussed it as a deposit product. Let's look at it as a working capital finance. So what is working capital finance? A business, an SME, a corporation, they want financing, right? So if they want financing, but they don't want it to buy a fixed asset, they want it for working capital. From an accounting point of view, working capital is not used for buying a machine and fixed assets, a property. It's used for your day-to-day expenses, paying salaries, do this, buy a little bit of equipment, buy a little bit, of, stock, commodities to buy and sell. So they will enter into a partnership, but the roles are reversed. So now the managing partner is the client, and the bank is providing the funding, and they will share profits according to agreed profit sharing ratio. So the IFP will enter into this Mudaraba contract. I'll check, it looks Wakala here on the slide, but this should be Mudaraba. So they will enter into the Mudaraba agreement, they will sign the Mudaraba contract, the client will be assigned, will be appointed as, profit, the client will be appointed as, the managing partner to manage this, and they will invest this in Sharia compliant business. So the business of the client has to be Sharia compliant. Like, unlike conventional finance, in conventional finance, you can finance, an alcohol production company. You cannot do this for Mudaraba, right? And then, subject to the performance of this business, the profit will be shared between the two parties as per the agreed profit sharing ratio. And the documentation will be the Mudaraba contracts and other security documents as per the agreement. This is property finance. We called it hybrid because it used more than one contract, right? Have you heard of the contract Ijara? What does it mean? Leasing, right? So we will see how you can have property finance only by Ijara, right? We have given you here a contract product that can use Ijara and other products to structure something that gives the IFSP more flexibility. So this product will use diminishing MUSHARAKA, which means declining balance partnership, Ijara, and Wakala, three together. So let's look at how this will be done. First, the client identifies the property and agrees the purchase price with the owner. So let's say, coming back to our friend Omid John, he looks for a nice, mansion of, I don't know, $1 million maybe in this case. So he likes the house, he negotiates the price, he doesn't buy it, he just agree on the price, right? Then the IFSP will purchase the property in partnership with the client. So they will establish a partnership in this house. This is called in fiqhi words, sharikatul mulk, partnership in ownership of assets. So this is not partnership in projects, it's partnership in this asset, right? So they become co-partners, they co-own this house, let's say 90%, 10%, depending on the deposit, right? Now, how can the IFSP makes money in this asset? By renting it out. So the IFSP will sign a lease agreement with the client where the client, if they want to live in the house, they can be the tenant. If they want to lease it to someone else, they will give them the right for subleasing. So there will be a Ijara contract. So first diminishing musharaka, then Ijara, right? So under this Ijara contract, the client has to pay monthly periodic rent to the client, to the IFSP for using the property, and the IFSP will take rent for their share in the house. So over time, the client will make monthly payment. Let's say the client will pay every month 2,000 tenge, 1,500 for rent, and 500 as acquisition payment to buy from the shares of the IFSP in the house, right? So over time, the ownership of the client will increase and the ownership of the IFSP will decrease until the owner of the house will be the client. And there will also be a third contract which is called service agency, meaning the client will act as a service agent because the bank is also an owner to do some servicing for the house on behalf of the IFSP. So this is in simple terms how it can be done. Why we use this and not use Ijara? Because this structure allows you to reflect ownership percentages at any point of time. In Ijara, you're just leasing. In diminishing musharaka, you can establish at any point, I own 50%, you own 30%, and then this helps the IFSP, for instance, if the client wants money, they can release equity, so they can sell them some of their shares. Under Ijara, it becomes tricky. How are we, going to give you money? On what basis? Ijara is just leasing. So if you want more money, then you have to reapply for financing, and it becomes a different, and how can you charge you more rent and less rent? So the industry moved forward and done this. It can be done in a different way, but we do not have the time for it, but maybe inshallah after the discussion. This is your final product for the day. And this is a trade finance, letter of credit. Letter of credit when somebody is exporting, an asset from abroad and they need the involvement of banks. The buyer and seller don't trust each other. So they want support from each other, from banks in terms of facilitating this. So we will see how we can do this on Murabaha basis. So the client wants to import something from abroad. Remember this example we talked about the machine? Imagine this time the machine is available, it's ready, it's not bespoke machine. It's just a machine you can buy, it's available. So the client identifies, the goods, the machine, negotiate the price with the exporter, and they get a quotation, right? So they go to the IFSP and they say, I want a letter of credit. I want you to give me financing to buy this machine, and I want you to facilitate the purchase transaction. I don't know the exporter, I don't trust him, so I want you to use your correspondent banks in China to facilitate this transaction through Murabaha. And
The IFSP approves the application and they appoint the client as their agent. So they say, we will appoint you as a client, as our agent, to complete this transaction. Right? So you go and complete the transaction as agent of the IFSP. So in this case, the IFSP, the client goes back to the Chinese guy and say, you know what? Okay, now I have the money. I will sign this purchase contract on behalf of the bank. I will buy this from you. We agree on the payment terms and everything. We sign the contract. And now the IFSP issues the letter of credit to the exporter through the correspondent financial institution. So now the exporter says, where is my money? You know, I don't know you. I'm sitting in China. I only know Chinese bank. I don't care about the banks in Kazakhstan. I said, okay, that's fine. So the Kazakh bank will talk to another Chinese bank where they are correspondent banks and say, give them the money, right? So they finish the letter of credit, they settle the money, and now the correspondent financial institutions pays the money to the exporter, right? So now the money has been paid and this machine is owned by the bank. But the bank doesn't want the machine. They want to make profit with the machine. So the bank, the IFSP, will sell this on a Murabaha basis, meaning this is the cost, this is my profit margin, this is the total sale price, and deferred payment basis. Pay me this money in, let's say, 6 months time, right? Or pay me in 2 years, 3 years. They agree on the installments, and the client pays the price as per the agreed installments. The legal documentation, there's a lot of legal documentation here. If you look at this first step, you have the agency agreement, right? You have the application, the facility letter, then you have the purchase agreement on behalf of the IFSP. Then you have the letter of credit documentation. And then you have the Murabaha contract. So you can imagine, you know, first, sometimes even there is a promise to purchase. The client will sign a promise to purchase. Then there is a purchase contract signed between the IFSP and the exporter, where the client will act as an agent. Then there is a Murabaha contract. Once the IFSP owns, then sell it on a Murabaha basis. Now, this is Sukuk guidelines. So this is a different document that we are presenting a summary of it today. This is about Sukuk. You know, Sukuk is the alternative words for bonds, the alternative Sharia compliance structure for bonds. We will have 3 sections in this session. The first one will be giving you an overview about Sukuk. What is Sukuk at a glance? Then we will look at the main types of Sukuk. That doesn't mean each and every possible way of doing Sukuk, but that's a good set of examples. And then we will see some innovation in Sukuk, some changes, some progress happening in Sukuk, and unique structures. And this session will be probably interesting not only for banks and financing companies and leasing companies, but also for investment brokers, advisors, because they can have a better understanding of this structure or this instrument. So let's start with Sukuk. This is the definition of Sukuk as per the IOFI Accounting and Auditing Organization's Sharia standards, right? So they define Sukuk as certificates of equal value, representing undivided ownership stakes, shares, units in underlying assets, projects, services. So immediately you can see the difference. Bonds represents, you know, bonds represents debt certificates, right? You hold the bond, you hold debt. Sukuk, it represents ownership rights. So you have an underlying ownership rights in a project, in an asset, in an activity. And you, of course, by this ownership, you will have access to returns and risks associated with this ownership. This is the definition of Sukuk as per the law on securities market, the securities law of Kazakhstan. So, and you will see it's more or less, used around the definition of IOFI. So it's still saying that, Islamic securities, that's the term used in the law. They're called Islamic securities, not sukuk. It's the same thing. And it's mentioned securities issued that correspond, the principles of Islamic finance. So, in your legislation, the mainland legislation, not AIFC, when they talk about Sharia compliance and principles, they use the term principles of Islamic finance. So they're telling you these securities are structured in accordance with Islamic finance principles, and they, again, the same thing. They represent certifying rights of ownerships in certain, assets, services, projects, and so on and so forth. So you can see the same definition. Right? Securities structured in accordance with principles of Islamic finance, representing shares in projects in ownership and so on. So essentially, sukuk are financial instruments. They could be issued by sovereign bodies, governments, quasi-sovereign, institutions owned by the governments. Also, it could be issued by corporate. These could be financial institutions, banks, leasing companies, business companies. So there are no restrictions who can issue sukuk. And by the way, many non-Muslim majority governments have issued sukuk. UK, Hong Kong, Luxembourg, South Africa, they're just some examples. So it's a financial instrument. Even if the government does not rule a Muslim majority country, there are other benefits of issuing sukuk. So what are the similarities between sukuk and bonds, and what are the differences? It's always good to compare and contrast, so you understand, and you don't get confused. And if you apply the same knowledge that, Omid John shared with us, do you remember in the beginning of the session when Omid John told you the similarities and differences between Islamic and conventional finance? We can apply this knowledge here. So for instance, when we talk about similarities, we are trying to achieve a similar outcome in a way that we are trying to extend funding from one party to the other, from investors to the obligor. The obligor is the institution that needs the funding, right? So sukuk are financial instruments that are usually marketable, tradable, and, transferable in primary and secondary markets. So just like bonds, you can issue them and use them in primary markets. So primary market, as some of you know, when you first issue the instrument, and then secondary market when it becomes traded afterwards between different investors. Just like bonds, they can be rated by local, regional, and international agencies. So, sukuk has to be rated as well. It doesn't have to, but that's a best practice. So, rating agencies will come and assess the sukuk, assess the underlying assets, the obligor, and give ratings to the investors about the, credit worthiness of the, issuers, the obligors, and also other areas. They're also subject to laws and regulations, just like bonds. So whether you are doing bonds or you are doing sukuk, these are regulated instruments usually. So you have to comply with certain laws, with certain regulations. You have to look at, how these instruments can be done in compliance with Sharia, the Islamic finance principles, and with the relevant laws. And sukuk can be structured using different contracts. You will see later on, just like the contracts we discussed in the first session, we will see how we can apply them in the context of sukuk, right? And just like conventional bonds, the more collateral and securities you add, the more you enhance the credit worthiness and the rating of the instrument. Differences. What do you expect the differences will be? Yes, please. Thank you. So one difference could be that sukuk can be structured as debt instruments and equity-like instruments, while bonds are always debt-like instruments, right? So in sukuk, capital and profit cannot always be guaranteed. In bonds, it's always guaranteed because it's a debt instrument. Right? By the way, you can do Sukuk with guarantees of debt. We'll seek some examples. But also Sukuk gives you the ability to do equity-like instruments. So you can have both. That's a very good difference. Any more ideas about differences? Thank you. So bonds are typically not asset-backed, asset-based. You know, you have in some exceptional cases asset-backed bonds, but it's very rare. Very rare. The standard, they are just debt unsecured instruments, while Sukuk are always asset-backed, asset-based, asset-linked instruments. Thank you. That's a good. What else? Ownership. Thank you. So you know, with Sukuk, you are representing ownership certificates. Bonds are representing debt certificates. And that also has implication on the contracts, right? So in bonds and Sukuk, the contracts will be completely different. And also think of the use of funds. In Sukuk, you have to use the funds in accordance with the Sharia requirements, while in bonds, you do not have this restriction. It could happen that bonds are used in a halal way, but the structure is not halal. Like you could have bonds are used in green finance project, right? So the objective is very good, but how you are doing the transaction is still, you know, not. It's like stealing money to do charity, for instance, right? I'm sorry, you know, maybe some conventional finance practitioners don't like the example, but you know, riba is haram technically, so you cannot get a haram money for the sake of doing something good with it. So it's still better than getting haram and doing haram, but does not make the whole thing halal, right? So, as we have discussed, you know, Sukuk are issued using halal contracts, Sharia compliant contracts. They fund only Sharia compliant projects. They represent ownership stakes. Selling Sukuk means selling sales. You know, ownership stakes. Selling bonds means selling, you know, debt. They are secured by ownership rights, and principal and returns in Sukuk are not always guaranteed. So, mashallah, you already are Sukuk experts. Maybe we should not do this session. You can go home early, and you can look at the Sukuk later on. You will have the guidelines at some point. So what are the key components of a Sukuk issuance? Who are the parties? Think of bonds. What type of parties you'll need a Sukuk transaction, in a bond transaction? Issuer? Underwriter? Sharia board? Investors? Say again, sorry? Auditors, rating agencies, very good. Yes, also, you know, arrangers, you know, distribution partners. I think you have, this is what I call this slide key components, because if we list all of them, we may have like 20. You have mentioned some of them. So let's look at this. First one is the originator. This is the starting point, right? This is the main party. We need somebody needing, the originator is the body, the institution that needs the money. Whether it's a government body, whether it's, you know, a bank, you know, a leasing company, or it could be, you know, a small and medium enterprise. You know, there are some experiences now in jurisdiction where SMEs are issuing Sukuk using blockchain technology. I should have said this in the innovation section, Sukuk. Okay, that's fine. Then we have, you know, arranger. You could have one, you could have more of them. Also these banks, you know, financial institutions that help in arranging the issuance, helping in setting up the documentation, the prospectus, you know, helping in you know, establishing other areas. And then we have the Sharia Supervisory Board, as rightly mentioned. So the Sharia Supervisory Board is a key element of Sukuk. Now, you don't have to set up a Sharia board for every Sukuk issuance. Sometimes, you know, Sukuk issuer, if they are an Islamic bank, they use their Sharia board. If they are not an Islamic bank, they can get an arranger, which is an Islamic bank, and the arranger can use their Sharia board, right? If they did not manage to find an Islamic bank, maybe they can use a consultancy who will provide the Sharia board service. So there are different ways of achieving this objective. Don't think of this like every time I have to do a Sukuk, I have to have a Sharia board, right? So you can achieve this objective without having a fixed, you know, Sharia board entity to your institution, especially when you are not like a fully fledged Islamic bank or an Islamic window. Issuer is technically, in the context of Sukuk, is the SPV. The special purpose vehicle, I will talk more about it. The special purpose vehicle is, by its name, it's an entity established mainly for the purpose of facilitating a sukuk transaction and act as an acquisition tool for the assets. Sounds too much jargon, right? Let's simplify. SPV could be a limited liability company. It could be a limited partnership company. It could be, in the English law, a trust, right? In the civil French law, it could be, I think, excuse my French, I think fondant, something like foundation company, right? Whatever is the legal form, I think, according to your securities law, it's a limited liability, it's limited partnership company. The objective of this entity is to take these assets of the sukuk, put them inside it, and ring fence it. So basically, the sukuk investors will have ownership in this company, in this SPV, that will protect the assets from the other assets of the obligor. So that ensures this segregation. Of course, it also helps in tax efficiency, right? Because, when you issue sukuk, there is a buy-sell transactions, and the Kazakh tax code identifies this and gives exemptions because they know they want to make sure that whether you issue bonds or sukuk, it costs similarly in terms of taxation. So neither an advantage nor a disadvantage, right? The term usually called in the industry is called creating a level playing field. So whether an issuer or an originator wants to issue sukuk or bonds, it will cost them similarly from a tax point of view. So that's also one of the purposes of having the SPV: segregation of assets, ring fencing of assets, bankruptcy remoteness. So if a company issues sukuk and they go bankrupt, the sukuk assets are protected, right? And sukuk investors have priority over these assets. Also the taxation efficiency element that we talked about. So this is why we need this issuer, which is technically the SPV, the sukuk. Underwriter, underwriters that helps in creating certainty for the sukuk issuance. So sometimes the banks, financial institutions, say that any sukuk that has not been sold, I will buy them, to facilitate this sukuk issuance. Investors, of course, without investors, the whole thing is not really, and these investors, by the way, sukuk investors around the world are not only Islamic financial institutions. Many big names in the industry like Goldman Sachs, HSBC, Standard Chartered Bank, all of them are involved in sukuk issuance and sukuk investing as well. Because it's a different financial instrument. It helps them in diversification. It helps them in achieving, different levels of, return risk profiles and so on. And then, of course, we need the assets that will underpin this sukuk transaction. So it could be asset-backed, asset-based, asset-linked. Let's start with Murabaha sukuk. So do you remember what is Murabaha? Come on, there was like one lunch between us and Murabaha. Murabaha, not Mudaraba. I know it's confusing. I don't blame you because I know the language is much easier to remember. Murabaha. Murabaha comes from the word in Arabic ribh, profit. Remember this profit disclosed sale, right? So there is a profit disclosed sale transaction. So let's look. The first step is the SPV issues the sukuk and collects the proceeds. So you have investors, they will get sukuk certificates, and the SPV has been set up, everything is ready, they get the money. Now, the originator sends a notice of request with undertaking to purchase the Murabaha assets to the SPV. Meaning, let's take an example. Let's imagine the originator is a company that manufacture fridges. And they need some raw material, they need some metals. They need some, engines to construct these fridges, right? So this is the issuer, the originator. So they will send a request to the SPV saying that, you know, we undertake to buy this 5 tons of this specification of the engines from you once you buy it. So please facilitate it for us. So the SPV will go and buy the Murabaha assets, usually directly from the, you know, the provider, or using an engine. So let's say if this fridging company, they have already a supplier, they can already arrange this before the transaction. So everything is there, just contracts are signed upon concluding the Sukuk transaction. So at this point of time, who owns these engines of the fridges? After stage 3, investors, originator, SPV. Who? SPV, which technically mean the investors as well, right? So, but SPV is the most correct answer. So SPV owns the engines of these fridges. What the SPV wants to do with them? Sell, yeah, you know, that's why it's called Murabaha. So sell and to achieve a profit with Murabaha, with ribh, right? So now they will sell this on the basis of immediate delivery and deferred payment and Murabaha. So basically they will say, we bought it with 1 million, we'll sell it to you with, you know, 1,500,000. This is our profit margin. And then you pay us, you know, in 5 years time, every 6 months, every 1 year, whatever are the Sukuk terms and conditions. So now the originator gets access to the engines, they can continue with their business, they get the funding they need, and they will make periodic, you know, profit payments, and these payments will go to the investors, right? And at the end of the 5-year term or 10-year term, the originator makes the final payment, and there will be a redemption of Sukuk. It could be that, you know, depending on how they structure it, not only the profit payments are made, but also parts of the purchase price. So depending how you do the structure. So is this clear? Very good. Now, legal documentation. Imagine how much documentation. First step, you will have the SPV constituent documents, right? To set up an SPV, you may have the, you know, articles of association, the trust deed, this contract, that contract, to set up the SPV. Also the Sukuk certification and so on. Then here we have a notice of request, an undertaken promise to purchase. Then here we have a purchase contract, an outright sale contract, right? There is no buying and selling, immediate money and then immediate delivery. Here we have a Murabaha contract, where, you know, you disclose the cost price, the profit margin, the payment terms, and upon redemption, I don't think there is any. Sometimes you have also credit enhancement documentations, guarantees and stuff. You know, under Murabaha, do you believe the originator can guarantee the principal and the profit? Can they guarantee it? Why? Is this a profit-sharing partnership? It's a sale. So imagine if I go to Omid John and I say, Omid John, I'll sell you my mobile phone for 10,000. In the market, it's cost 8,000. I tell him, I'll sell you my mobile for 10,000, and you pay me over 2 years. Every month, let's say 100 or 80 or whatever, right? You know, installment sale. There is nothing wrong with it. I'll sell him the mobile, whatever we agree. He pays me every month. Now, can he come and say, you know what, this is a halal sale. I cannot guarantee for you the payment of your money. Only Allah knows, right? He cannot do that, right? You know, because the sale, once you conclude a sale, you generate debt, right? So the minute we finish the sale, the relationship becomes creditor-debtor. This is why conventional bankers like Murabaha. Because in the beginning, it can be a little bit inconvenient buying, selling. But once you finish this, it becomes debt. And they are used to manage debt. right? And by the way, creation of debt from a Sharia perspective is not something prohibited. Creation of unmanageable debt, creation of unrealistic debt that you cannot afford is disencouraged and not allowed. Right? But if we all need creating debt in different ways. You can create debt by Qard hasan, by a loan, interest-free loan. You can create debt by a credit sale. You can create debt by a lease contract, you know. When you rent a house, every time you have to pay a rent and you don't pay it, it becomes debt. So keep that in mind. So in terms of tradability of Sukuk, Sharia scholars and IOFI Sharia standards say that we have to look at the underlying assets and what is the composition of the assets. Because remember, you know, selling money for more money or less money becomes riba, right? Trading money or trading debt, so debt, money, receivables, they are all the same. We cannot sell them for more or less. So this is why Sharia scholars said we have to look at the asset composition. And if the majority of these assets, meaning more than 50% are cash, receivables, debt, then we cannot trade this instrument without ensuring that this is transferred at par value. So there is no profit and no loss. Right? So Murabaha, once you complete the sale transaction, Murabaha Sukuk represents pure debt. Right? This is why usually Murabaha Sukuk are not tradable. You don't trade them. Unless, you know, you bought them with 500,000, for instance, and there is 2 installments left that will make the whole thing 600,000, then you transfer them at 600,000. You have not made profit or loss. That's transfer at par value. Otherwise, you know, Murabaha is not tradable. So this is very important in Sukuk structuring. Ijara Sukuk. This is probably the most preferred structure by sovereign entities. Hopefully we will see government of Kazakhstan and Ministry of Finance issuing Ijara Sukuk. Just to make sure there is nothing lost in the interpretation, I'm not saying this will happen. I'm saying hopefully, inshallah, this something will happen. So I'm not speaking on behalf of the government or the Ministry of Finance. It's good this is recorded, Medina. So, we all know Ijara. We discussed it in the first session, leasing. As usual, we set up our beautiful SPV. It's ready. Issue Sukuk, collect proceeds, right? So the SPV needs something to lease. So let's take a practical example. I'll give you, let's say, the UK government Ijara Sukuk. So this is the UK government. The SPV issued the Sukuk, and they have some head offices of one of the government ministries in London. They value them and they look at these different offices, and the price of the value of these are 200 million pounds. Right? So they put these Sukuk, these assets, as the underlying assets of this Sukuk. So now they will sell these, you know, properties, buildings of the government facilities to the SPV. So we will sell it to you and give us 200 million pounds. Right? So now who owns these properties? SPV. So the SPV, what they will do next, they will kick all the employees of the government out of their offices, and they will rent it out to maybe, you know, a halal kebab shops. No, they will not do that, right? So what they will do is, they will sign a lease agreement with the, you know, government to say, okay, you keep your staff there. Everybody stays calm. Don't worry. There is a new owner in the house, but nothing changed. You use our offices and you pay us rent, right? So they will use the offices and everything is good. But then the government says, what about, you know, cleaning this? You say, you clean it. You know, you are using it. As a tenant, it's your right. But the employee said, what if we have a wall and there is a crack in the wall? Then in this case, the SPV would assign the originator as their service agent to do this kind of services, major maintenance, right? and provide this service. So this is why you will have, every time you see Ijara, you think of Ijara, you have to think of service agency. Because as an owner, as a lessor, right, you have responsibilities toward the people who are using your property. It's not about, cleaning the house every now and then, but it's about major maintenance, Anything, usually major maintenance is defined by anything that obstruct the proper and normal usage of the underlying property and asset. So now, originator don't own the property, but they own the usage of this property by the contract of the Ijara, so they can continue using it, and then they will pay rent periodically, and that rent will be channeled to investors. After a few years' time, the government wants their buildings back. So that's fine. We don't need them. We sell them back, and we do the redemption of the Sukuk, and the whole thing will be over. So no kebab shops, nothing. It will be just the office buildings back to the government, everything in place. So what will be the legal documentations here? Constituent documents of the SPV, that's always there. Here you have a sale contract. You bought the property. This is not a Murabaha sale. They just buy it at the same price and sell it back at the same price. Right? So there is no change in the price. Then you have here a lease agreement and a service agency agreement where, the SPV would appoint the originator as a service agent, and they will lease the underlying assets to them. And at the end, here, there is a purchase agreement, right? So you return this agreement. There has to be agreements of buying and selling. Now, some of you may ask, is it allowed to fix the price like for 5 years from a Sharia point of view? Why you are not using the market value? Is this fair? So the Sharia standards of AIFC say that, the parties can agree on a price, right? That's one thing. So it has to be agreeable. They always recommend looking at the market prices and the fair value of the property or the underlying assets. But they also recognize that for, properties, they usually, have kind of stability in their prices, especially in short term. So they accept in this kind of contracts where the underlying assets are land or this kind of properties under Ijara contracts, they accept that you can fix the price at the beginning. But for other contracts like partnerships, businesses where there is high volatility in prices, it's a different story. So do you think Ijara Sukuk is tradable? It is tradable, right? Because it represents ownership stakes in the property. Now we're looking at Musharaka. Do you remember what is Musharaka? Partnership, yes. So this is partnership where 2 or more parties providing money, and some of the parties may be assigned as the managing partner to deal with this partnership activities. So again, we first establish the SPV, issue the Sukuk, gets the money. Then the SPV and the originator enter into a Musharaka arrangement, and the originator is appointed as the managing partner, right? So we agree on to entering into a partnership. We provide the Sukuk money, and then the originator provides some of their money or something else, we will look now, and then enter into this partnership. The originator is appointed as the managing partner, right? So the one who will be making decisions about this partnership. Now the originator provides, for instance, a piece of land for the project as capital for contribution in kind, right? So let's assume, they want to set up a factory, right? So the originator have the land, they provide the land. The Sukuk, owners, they provide the money to build the factory, right? So and then they can price each of them, and you establish that partnership. SPV pays the Sukuk proceeds on the capital in contribution in cash, and now they have the partnership. And then based on the performance of this partnership, there will be sharing in profit and losses potentially. And then usually there will be an agreement on an expected profit rate to make it easier for investors to see how much they will make. So, imagine, I think, the UAE company, it's called Tabrid. I think like a government-owned company, they wanted to build factories that will start, manufacturing and selling, I think, fridge, cooling equipment. So in the first 2 years, they spent building, and then they started selling and making money. At the end of 5 years, they can do the calculation, the profit, and do the payments. But meanwhile, they keep continuing pay profit, sometimes profit in advance payment. So it does not disturb the flow of the transaction. So SPV will pay periodic profit coupons, and at maturity, the originator will buy back the share of the assets issuers, of the share of the SPV and the investors in this project. So the project will be fully owned by the originator, and the Sukuk investors will get their money. So you can implement this in many different ways. And legal documentation, you can think about this: constituent documents, partnership agreement, musharaka agreement. And then you have, at the end, you have sale agreement where you conclude the, musharaka, you finish and you sell your shares. Sometimes the same musharaka agreement can enable you to sell your shares under the same. And of course, there might be some security documents. So is musharaka tradable? Do you think it's tradable? Thank you, Haidar. So musharaka usually tradable, but we have to look at the composition of the assets. So sometimes, imagine if musharaka, in the first stage, 2 years, the land value was maybe 20% of the whole partnership value. So you cannot trade it maybe in the first year, for instance. But usually musharaka sukuk are generally tradable, but we have to look at the asset composition. And this is part of the obligations of the originator to disclose in the agreements, the prospectus, that this musharaka is tradable, and the originator will ensure that the asset composition remains always, tradable. Wakala sukuk. You remember what is wakala? What? Agency. Yes, thank you. So how do you envisage this sukuk will look like? If there is some investment agency or some kind of agency, how do you think it will look like? Imagine a bank issuing wakala sukuk. How do you think it will look like? So it could be two things. They already have an existing portfolio and securitize it. So imagine you have a bank in Kazakhstan. They have like a portfolio of 500 million tinges of Ijara-based, home finance. They put this portfolio in the SPV, securitize it under an investment agency agreement. They get more money, they can do more business. It could be the other way around. They get the money, but they don't have the business yet. So you may have some restrictions in this case on tradability. So they start using this money in a Sharia compliant way for funding. Usually this could be good for complementing, the capital. I will talk about this later on, of how we can use this to supplement the capital of the bank. So as you can expect, we'll always have our favorite part, the SPV set up, ready, get the money, get the sukuk. Then you have the originator allocating undivided shares in their pool of assets against the sukuk proceeds. So this pool of assets, imagine an Islamic bank, they have their portfolio. They transfer the ownership of this to the SPV. There are two ways of transferring the ownership. You have one way where you transfer fully the legal title to the SPV. Whenever you have a legal title, sometimes you transfer the beneficial ownership. From a legal point of view, you're transferring the rights of use, the rights of user-fract beneficence and other legal terms and jargon, which essentially means you have the right to use this and benefit from it, but the legal title remains with the originator. Usually, Sharia scholars and IOFI standards prefer to do the asset-backed, where you fully transfer the legal title. But asset, the other type, where you transfer the beneficial ownership, is called asset-based, right? And that doesn't mean asset-based are not Sharia compliant, but they are looked at from a Sharia scholars, point of view, Sharia standards point of view, as less appealing, if you want, less encouraged. So now these pool of assets are generating money. Remember, in the example of an Islamic bank, you are getting rent every month from this Ijara-based portfolio, for instance. So because SPV now owns this, they have the right to get the profit allocation to them, right? But subject to an expected profit rate. So think about it like this. The portfolio is generating 20%. They issue the Sukuk and they say, as an investment agent, we will use your money in our portfolio. We expect to achieve for you 10%. Anything over and above is ours. So that ensures the bank remains benefiting from this portfolio. But at the same time, they have managed to release the money so they can have more asset ownership and more financial transactions, and they can generate more profit, right? So they're sacrificing some of their returns that will be shared. At maturity, so let's say after 5 years, the bank wants their assets back. So they will exercise, they will agree on a purchase price. Usually it's part of the documentation and Sukuk, and highly likely it's fixed. And there will be the redemption of Sukuk. Or IOFI Sharia standards, in Wakala, MUSHARAKA, Mudaraba type of arrangement, they don't agree with the fact that you can fix the price from the starting point of selling back again. Because, this could be fluctuating in terms of the value, the market value. They believe it's fairer to look at the market value or an agreed price. But the practice in the market usually that investors and originators are both happy with fixing the price from the very beginning. So this is why, this area has been a little bit a challenge in terms of the Sukuk issuance and Sukuk market. So legal documentation, you have the constituent documents of the SPV, you have, the sale arrangement, allocation agreement to transfer the assets to the SPV, you have the investment Wakala agreement, and then you have another agreement which to sell back or release the, portfolio to the SPV. So you can think about it like this. I have this portfolio, I sell it to the SPV, then they assign me to manage it for them. Right? When we finish, I buy back my portfolio. Right? So this is as simple as that. Tradability, do you think it's tradable? No? So what is the benchmark for tradability? What we need to do first thing? Look at the composition of the underlying assets. If this bank is a big fan of commodity Murabaha, then this portfolio will be all debt. Right? So they cannot securitize it. At least they cannot securitize it using Wakala. Because, how can you create profit from debt? And even if you securitize it, the bank can actually securitize it, but it will not be tradable, Right? So basically, because, the assets are there, but they are transferring, because what they will do is they will transfer this and buy it back at par value. But they are actually assigning the collection of debt and receivables to the SPV. Right? So anyway, not to avoid any complexities in this, you have to look at the composition of the underlying assets. Whenever the percentage of debt, cash, receivables is more than 50%, it becomes, according to IOFI Sharia standards, as, measurely debt, and it is not tradable, right? You may ask, where did they come up with this 50%? Some of them say the third, 33%. This is ijtihad. Ijtihad means like kind of independent reasoning, where Sharia scholars have looked at, some of the ahadith, and one of the sayings of the Prophet ﷺ that, in relation to inheritance, the discussion was about, how much can be donated of the inheritance to charity. So the Prophet ﷺ, he said the third, and the third is too much. So scholars looked at it and said, if the third is too much, then we have to make sure that debt does not go. The non-debt should not be less than a third. So we always maintain at least a third. And from there, they said, let's announce to the public that they have to stay at half. So when it goes less than half, you have a buffer. I don't know if I said too much information or... But it is, in simple terms, you should always have at least 51% of your portfolio as, non-cash, non-debt, right? Non-receivables. So in order to be able to trade this. By the way, in some schools of thoughts in Malaysia and other countries, they allow trading of debt based on, just the debt that is usually generated from trading transactions, right? But that's not the view of the majority of schools of thought. I think, Kazakhstan is a Hanafi, majorly. And IFAAS Sharia standards are in line with the Hanafi madhab in terms of, the issues of trading debt. Istisna Sukuk. Do you remember Istisna? Manufacturing. Remember selling manufactured. So Istisna, you have a case of manufacturing and selling. So as usual, we set up the SPV, we collect the Sukuk, we collect the proceeds, we issue the Sukuk. Then we have an originator. Imagine the originator that wants to, get the money to build up a factory. Right? So they need this money to build a factory or a machinery. So the SPV will enter into the Istisna contract to purchase the Istisna assets from the originator and makes periodic progress payments accordingly. So now the SPV agreed they will enter an Istisna contract to purchase the Istisna assets from the originator. So the originator has to provide the assets and the SPV will buy them from them. So the SPV appoints the originator as their agent to sell the Istisna assets once manufactured. So SPV doesn't want the assets. So in this case, imagine the originator is, let's get something more practical. The originator needs cash, they need funding, and they sell cars, right? So the SPV will say, okay, I want you to manufacture for me under an Istisna contract 500 cars, right? But the SPV doesn't want the cars. So they will appoint the originator, say, these 500 cars, I appoint you to sell them to your clients as long as you achieve this profit margin for me, right? So now the SPV owns these cars. Every time a car is finished, it will be sold, they will make their profit. So the originator undertakes to sell the Istisna assets at a price that will ensure they achieve that profit margin. Now, think about this, right? So they are saying here, I cannot sell these cars with anything less than what we have agreed. Otherwise, they will tell them, oh, you know what, we have made a loss, sorry. So meanwhile, because this is Istisna, they don't give maybe all the money at once. So they may give them like progress. They manufacture 100 cars, they give them payment. They manufacture. So the SPV may actually invest some of their money in Sharia compliant investments. So some of the money that they have not given the SPV, some of the money that has not been provided to the originator could be maybe used in, investments in Sukuk. Like, so the same Sukuk is actually investing in Sukuk. Like some Sukuk issued by government Sukuk, sovereign Sukuk, to create some profitability. Sometimes you don't have this. They just provide, all the money at once. Sometimes it could be progress milestones. And then based on this, SPV will start receiving periodic profit payments every time they manufacture they sell. And usually the way it will be done is if the profit has not been achieved yet, it will still be paid as per the agreed terms and conditions. But from a Sharia point of view, it will be considered as an advance profit payment, right, on account. And then at maturity, the originator delivers the istisna assets and then sell them as agent to the end buyers, the clients who wants to buy the car, and create this profitability. And the originator pays the sale price, the principal plus the profit of the istisna, and that will be the SPV redemption. They're a little bit complicated, maybe too much complicated. But you know, imagine we are doing like a quick overview. When you want to do this, you can go to the guidelines, read the conditions, and these are not standard set in stone. You can use istisna in 10 different ways. You know, you can actually do sometimes what is called, hybrid contracts or hybrid sukuk, where you have istisna, ijara, agency, this and that, and you structure it the way you like it. It gets interesting. This is actually called Islamic financial engineering. So it's a science on its own, where you need to understand, banking, finance, economy, Sharia law, and so on and so forth, to be able to come up with something that works up with everyone. Of course, the documentation will include the constituent SPV documentation. It will include the istisna agreement, sale agreements, and the security documents, collateral, whatever is provided to enhance the credit rating of this instrument. Tradability will depend pretty much on the underlying istisna assets of this sukuk. So how much is the percentage of cash, debt, receivables, and whether this percentage, is more than 49% or less than 49% to make sure it's tradable. So let's look quickly at some of the innovation in sukuk. Let's start with ESG sukuk. So on top of whatever we have discussed, then we add the element of ESG, right? So, ESG refers to environmental, social, and governance factors that need to be considered by the originator, the sukuk issuance, and so on. So in a sense, the originator will be under the microscope, and the money received through this instrument will be under the microscope to ensure that they meet certain criteria defined under each of these categories. For instance, environmental. They will look at the sukuk originator and what they will do with the money in terms of their impact to the environment. Are they doing projects like, like energy, solar energy? Are they doing things like, cleaning sources of water? Also, they would look at, are they having some practices in relation to, their production that is adversely affecting the environment? Are they discharging some chemicals in the sea? So there are a lot of criteria and different agencies that provide different, factors to be considered. Social is more about looking at the social element of the originator and the use of funds, how they are treating their employees, how they are treating their stakeholders, not only the shareholders, but also, the relationship with the community. Are they doing some charity work and so on? There are a lot of factors. And governance is more of ensuring they have robust systems, to ensure, independence of certain functions within these organizations. They have proper controls. They have board of directors. They have boards of, management. They have external auditors, internal auditors. They have enough control of how the money will be used. And then you have the principles of responsible investing. It's a UN initiative where they provided guidelines of what kind of ESG criteria needs to be compliant to call your sukuk ESG sukuk. One example is, Kuwait Turk Bank. They have issued ESG compliant sukuk in 2021. I think they have used this to support their activities. So they actually used it to supplement. It was a tier 2 sukuk. I will talk about this tier 2 sukuk. Then you have a green finance. which is, in my view, a subsection of ESG, where you do sukuk, whether it's Ijara, Murabaha, or whatever, but then these sukuk are used to fund projects related to climate and environment, create a solar panel, project, do something to clean water, build green, friendly buildings, save energy, and so on and so forth. Same thing, we have a number of reporting requirements, agencies that look into this. And these green sukuk, they have a lot of inspiration, and they are sometimes, structured in accordance with the Sustainable Development Goals. Sustainable Development Goals of UN are general principles where you can align these green sukuk with them, fighting hunger or, free education for everyone and so on. So this is also in line with the vision of the Green Finance Center of AIFC. So, there is a Green Finance Center at AIFC, and they are encouraging green finance instruments. So you get best of the both worlds, Sharia compliant and also doing something beyond just, borderline permissibility towards beneficence of how you do things. This is the last slide, I promise you. Maybe the next slide will be thank you for your time. So this is another type of innovation, but here we are looking at structuring. Perpetual sukuk. Perpetual sukuk are technically sukuk issued with no redemption time defined. And these are called additional tier 1 capital sukuk. What does it mean? For some of you who are involved in banking, the capital of a bank has 2 levels. 1 and 2. Within 1, you have also 2 sub-levels. The first one, which is called, CET, I think capital equity shareholders, that's where you have mainly the equity shareholders funds. You have other components, but mainly the shareholders fund. So when you have an event and there are losses, that will be used first. Then you have the additional tier 1, which is this type of instruments that will come after the shareholders fund, right? So this is in line with Basel III requirements. So this type of sukuk has a high degree of loss absorbency and equity-like features. So a bank would issue them, and they will not give any certain date for redemption. They're like supplement the capital. But the difference is they will have like an expected profit rate every year. So subject to achieving that, they will be given their profit. So 81 sukuk should be capable of being converted into common equity or written off subject to contract. So as part of this sukuk, they can be converted to equity or they can be completely written off. So you have a higher risk exposure, right? But of course, the sukuk terms and conditions will define this. And redemption could be included subject to defining the trigger events. So for instance, if you want this perpetual sukuk to be redeemed, certain trigger events are defined in the terms and conditions. But usually they are perpetual sukuk, so you have them, theoretically indefinitely. An example, so the structure that is used and preferred by the IFSB is MUSHARAKA. So IFSB, remember the Islamic Financial Services Board, one of the standard setting bodies in the industry, they recommend using MUSHARAKA. It makes sense because MUSHARAKA is the bank is providing money, the sukuk holders are providing money, and they are sharing losses together. But some market participants have used Mudaraba, right? But IFSB a little bit objects on this because Mudaraba means the bank is not providing money. But in a sense, they are using this money as part of their business. But let's agree that IFSB got it right. And then the benefits of perpetual sukuk, of course, it helps in extending the capital. It helps in meeting regulatory requirements. And it helps in providing a unique type of instrument also for investors. The first perpetual sukuk was issued by Abu Dhabi Islamic Bank in 2021 for $1 billion. This has managed significantly to drop down their cost of funding. Imagine you asked for 1 million, for every million you ask, you got 30 million. Oh, I forgot there is this last slide. Sorry, guys. That's tier 2 sukuk, right? Remember, we talked about tier 1. Now this is tier 2. So when there is a case of losses, you first consume tier 1, then you go to tier 2 sukuk. So tier 2 sukuk are considered part of the gun concern capital. It's a term, you have ongoing concern. A gun concern when the bank is, basically in a mess and the bank is going to bankruptcy, then at this point of time, you can touch this money. Right? This is why it's tier 2 sukuk must absorb losses after exhausting tier 1 capital, but before depositors and general creditors. So this is the tier 2 sukuk. The objective of it is also to supplement the capital, but after exhausting tier 1. So it's less risky. So this, unlike perpetual sukuk, they will have a maturity. Usually the typical term is 5 years, but you can have more. And these sukuk should be able to convert it into common equity or written off. Of course, the terms and conditions will be defined in the sukuk. IFSB says that tier 2 sukuk should be structured either on Mudaraba or Wakala. Think about it in this case because you have already exhausted tier 1 capital, so there is no capital left. This is why Mudaraba makes sense, because under Mudaraba, the sukuk holders provide the funding and the bank provides the management, or Wakala, where they act as an investment agent. Benefits of tier 2 sukuk, what do you think? Supplementing the capital of the bank, providing a new type of instruments for, issuers. And by the way, the ESG compliance sukuk, this Kuwait Turk Bank was actually, tier 2 sukuk as well. And, one of the key things about tier 1 and tier 2 sukuk, because there is a lot of events that could trigger things, conversion to equity, writing off, we have to ensure the terms and conditions are 100% clear. They have to be 100% clear to avoid falling into our dear friend, the gharar that John has spoken about in the early session of the day. Clarity is very important. And commitment to finish sessions on time is as equally important. So I would like to close this session by thanking you for your patience. Rahmat, for all your listening. You are the patient of the patient that have survived till after 6 p.m. We wanted to do the session earlier in the day, but things did not work as planned. But once again, thank you. I hope you would enjoy reading the Sukuk guidelines. That will be published by IFC in due course. So inshallah, you will receive them this year, that's for sure. All these guidelines. This is the objective here is to incentivize you to look for them, right? So inshallah, you can have access to them. Medina, would you like to say a few closing words before I finish, or you just want to go home? She wants to go home. Thank you very much, Rahmat. If you have any questions, please feel free to ask me. I'm here. And I have my cards with me, of course. If anybody would like to get in touch with me later on or with John, we feel free to do this. Thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh.